valuations have actually, some people think have gotten too high. I mean, there was this rally in stocks and in debt. Do you think that there's maybe some weakness going forward?
Well, that's a good question, right? I think if you were Rip Van Winkle and you'd been asleep for the last year, you'd wake up and wonder what the big deal was. I mean, from a year ago till now, stock market is basically at the same level. It's going to be seeing the positive side of 10,000 rather than the negative side of 10,000, but it's in the same zip code. Credit spreads, for the most part, are tighter than they were a year ago. If you didn't know all the mayhem that had happened, this time last year through the first quarter, you could really wonder what the big deal was. Well, I think that valuations, when we look at and just narrowly at the kinds of things that we own, I think people are looking at things pretty rationally, and so I don't know to the extent that I'm not really qualified to make broad assessments of what do I think the value of the stock market or some big broad market would be. But on a narrow basis, I don't think things are at all discordant. When we do have people make investments, they tend to do so on a pretty studied basis. The debt levels are vastly more rational and kind of more transparent than they were 2.5 years ago. So I think this is actually one of the other aspects of the power of zero is that if money is sitting in your bank account earning zero, after you don't believe the world is going to end, you need to find ways to put that to work, and that probably has something to do with the capital flows in the equity markets, I would suspect.
Right. So. With respect to private equity in general, do you see the industry getting back on track? It's taken quite a beating, and will the downturn, the most severe since World War II, have any lasting impact on the private equity industry?
I think things are a bit different. I think that there's a great place in the world for private equity capital. I think it's the right form of capital for longer term, illiquid investments, and that's great. I think your investor base has had a lot of trauma over the last year as well, though, right? The state funds and foundations and people who make the illiquid investments. So I think you're going to see probably less capital raised on a go-forward basis for some period of time, at least among the people who are invested now, as they try and repair their own balance sheets. And I do think that it'll be some time before you see the kind of mega funds and the mega transactions that were done at the end of 2006, early 2007. So I think it's not dead by any means. And we see people looking now and reassessing what their capital structures are and how much capital they're going to create or commit next year, et cetera. But I think it's a much more studied investment program than it was before.
Okay. I know. I mean, a lot of several funds have had a great difficulty raising capital. There was a story in Bloomberg today about CalPERS, one of the largest institutional investors, significantly cutting back its allocations to private equity. So kind of portends at least some temporary shrinkage in the capital base of the industry.
Yeah, the question that I think is a really good one is what's the right asset allocation model? When you look at the work that was done kind of historically at allocating between stocks and bonds and then non-traditional investments like alternatives and the like, I don't think there was as much attention paid to the notion of liquidity. Right? So people were looking at kind of an efficient frontier of the kinds of things they should invest in without maybe paying as much attention as they could to liquidity. And when you go through the kind of market that we had earlier this year, everything becomes correlated. Right, so you'd think, geez, real estate's very uncorrelated with maybe stocks or with bonds or whatever, and then you have the kind of year that we have, and this correlation is 1.0. And so kind of the worst thing happened at the worst time in every market, and that's really what I think has caused people to stop and step back and say, gee whiz, if I'm gonna tie capital up on an illiquid basis, I need to make sure that I'm doing it for exactly the right reasons and getting the right kinds of returns. And so I think that I don't know the specifics of the story you're talking about, but I suspect that that's what's behind that. But we do think that the appetite for people on alternatives, I think ironically, could be enhanced by this kind of a market, because alternatives in their purest form are incremental returns to what the market has to offer, and 0% interest rates on the fixed income side, and full equity valuations. those are the mainstays of what people's alternatives are. I think they look at that and say, geez, if you can really generate incremental returns, we're very interested in that. They may gravitate towards more liquid strategies, I think, than the tied-up strategies, but we see a lot of actually interest on the alternative side. And I think it could be a really good period in the aggregate. It just may move around as to what the mix of it is.
Okay.